Do you want to know how to invest money to make money? If so, you're not alone. A lot of people miss that an important element of investing money to make money is taking advantage of those ups and downs or cycles that are happening in the market. In this video, I'm going to tell you how you can capture cycles in the stock, the bond, and the real estate market. Hi, I'm Camille Gaines, founder of FinancialWoman.com, financial coach, and author of Earn, Grow, Give, a personal finance book for women. You may have heard or read or been told long-term investing is so important. You don't need to worry about how much you're putting in or when you're putting money into the market or how much it costs when you do invest in stocks. You just need to be a long-term investor. And that can be true in many situations. But if you don't have that long until you need your money, such as you're approaching retirement, maybe you're in your 40s or 50s, then you'll want to make sure that you pay attention to the cycles that are happening in the market. There's no doubt about it. When you're able to capture those moves, those trends or cycles in the market, there's no doubt about it. You're able to accumulate wealth faster. And that's just how it is. If you buy something cheaper and you write it up, you're going to make more money with your investing. Can you pick the tops and bottoms? No. Am I encouraging market timing? No. My father used to say, Camille, it's really hard to pick the exact tops and the bottoms. But if you can just ease in and ease out somewhere near those tops and bottoms, then you'll do well with your investing. And I've always remembered that message. I want to share with you in this video the three major markets of stocks, bonds, and real estate, and clues that you can use to know, or tools that you can use to have a better feel for whether or not you're buying near the top of the market or near the bottom of the market. So first of all, there's stocks. So for stocks, I suggest that you look at the index fund, the S&P 500 index fund. If you don't know about that, be sure to look at my other videos. I talk a lot about index investing. The best way to look at the performance of the stock market with that S&P 500 index is simply with the stock chart. You can Google a long-term stock chart for S&P 500 index, and you'll get lots of great information. You can also look at my video where I show you how to look at a stock chart. So that's number one, is for stock investing. Look at those charts and see. You'll see it goes up and down and up and down. And you'll see big ups and big downs, as we saw in the early 2000s when we had the 60 up to 60% correction in some areas of the stock market, and over 50% corrections that we had later on in the 2000s, in the 2008 period. So that's what you want to avoid, is putting market in right before those, big 50% drops that take so long to recover from. Again, if you're a long-term investor and you have a couple of decades to invest, you may choose to ride out those ups and downs. If not, and you have nearer term goals, you'll want to do this. You'll want to take a look and see where those cycles are now. So that's what you'll do for stocks, For bonds, what you'll want to do and understand is that bonds move in relation to several things, but most importantly, interest rates. That's because when you buy a bond, you get paid the interest that's stated on that bond. So it's sort of like, I like to say it's like a bank, and you're lending money to someone. So, and they're going to pay you interest while you're lending that money to them. So bonds can be short bonds that are only for a few years, or they can be a long time, like 20, 30 years. The further they go out, the more they're going to change in value due to the interest rates. So long-term bonds will move down in value when interest rates go up. So I suggest looking to see where we are in the interest rate cycle when you want to have a good feel for where we are in the bond cycle. Believe it or not, interest rates were as high as about almost 20% in the early 1980s. As I record this video, we've seen unusually low interest rate for many, many years now. So remember, when interest rates go up, the value of bonds, especially long-term bonds, go down. That makes sense. People can get a better interest rate on those new bonds with the higher interest rates, right? So the value of the old bonds is going to go down. This would apply to if you own individual bonds, or as most people do nowadays, they own bonds through some sort of fund. Real estate is the third area I want to talk about, and you'll probably relate to this. It seems like you don't really know, but if you think about it, you do know what's happening in the real estate cycle. For sale signs are all over the place, and I remember driving through Sarasota, Florida after the 2007 market correction. Every other house had a for sale sign. It was devastating. The market had been just decimated at that point. So it may not be that obvious in your area. It depends on where you live and how the market holds up. But when the real estate cycle has been near the bottom or is at the bottom, then you're going to see those for sale signs everywhere. You're going to see lots of inventory. It all goes back to supply and demand. Lots of inventory, lots of for sale signs. When the real estate cycle has really been strong, maybe strong for many years, then you're going to see many less signs that have for sale for real estate. It's intuitive and it seems rather silly to state this, but a lot of times we miss this. And so just pay attention to the signs. The other thing with real estate is that you'll hear that everyone is trying to buy, and maybe when someone makes an offer on a real estate or home, people overbid, and there's a frenzy about getting into a home when there's a near top of the cycle. And I would say that often there's a frenzy around anything that is in a very, very strong and overextended and overpriced market. So that's what I wanted to share with you in this video. For stocks, take a look at a long-term stock chart, the S&P 500. For bonds, what you'll want to do is pay attention to the interest rate to have a feel for where we are in the market cycle of bonds, especially longer term bonds. And real estate, just pay attention. Look around your neighborhood. Look at the signs, literally, and see where we are in the real estate market. That's what I wanted to share with you in this video. If you like this information, please let me know by clicking the like button in the bottom there. And be sure to follow my channel if you want to learn more about investing and about creating the life that you want.